is not for Texas Golf. All right, someone log me in. Thanks, man. Go ahead. Yeah.
That'd be great. Well, let's be honest.
Unless I get mine on too. Oh, wonderful.
I've like been so busy.
Okay, we're in. Yeah.
Thank you. I'm just gonna find all the stuff.
Usually in class, but then we teachers in classes never really. So I don't know. Yeah. 5 pages. Oh yeah.
Thank you, Mara.
I'm literally doing something.
All right. So, good morning. Good morning. Thanks to Mariah, we actually have Westlaw. Okay. So, filed versus furnished. I hope you didn't waste too much time on this, because none of you were a match for our very own dear Professor Coffey, who has a good memory, and he remembered that back in the day, what is back in the day? Well, if you go down to Westlaw, so if you go to, I just picked Rule 14A6, which is 17 CFR 240 14A6. These are the rules governing the filing of proxy statements under the 34 Act. We are not doing proxy statements in this class because you generally cover them in corporations or M&A. But what's nice is that you can go down here and see the evolution of the law. So if I go back to the first version of this rule in 1952, and I look at a true old document, if you go to 14A6, 14A5, no, sorry, 14A3, for some reason you can actually find, this is really hard, you can actually find this, you cannot find this Federal Register release in the Westlaw history for 14A3, but you can find it in 14A6's history. But then having opened it, you can now look at 14A3. So don't worry about this unless you're interested. You can just ignore the next 2 minutes. But for those who were really puzzled by filed versus furnished, in 1952, at least, Rule 14A3 is titled Information to be Furnished to Security, I guess, to be furnished security holders. And subpart A says no solicitation, that's a proxy solicitation for those who've taken corporations or M&A, subject to A1 to A10, this subchapter, essentially Rule 14A, shall be made unless each person solicited is concurrently furnished or has previously been furnished with a written proxy statement containing the information specified in Schedule 14A. So the original proxy rule, this is not on the exam, this is not anything you need to worry about, but for those who are really spending hours on this, and the original distinction between filed versus furnished, what did those terms originally mean? Well, there was a time when you could comply with a rule under the 1934 Act by furnishing some information to security holders, to investors. And there was no requirement at that time that what you furnish investors be provided, be filed, let's be precise, be filed with the SEC, except for subpart C, which provides that 3 copies of each annual report sent to security holders pursuant to the section shall be mailed to the Commission solely for its information, not later than the date on which such report is first sent or given to security holders, The annual report is not deemed to be solicited material or to be filed with the Commission, or otherwise subject to this regulation and to the liabilities of Section 18. So a few of you pointed out the modern practice under Section 18, which we'll get to, and how you can call a document even today, or certain parts of 34 Act disclosure, not filed. But where did that come from? Sort of like, what was the original distinction between furnished and filed? Like, what do those terms actually mean? Well, it turns out that originally, going back to the 1950s, the term furnished was used to refer to information given directly to investors via a mailing of some kind. And that, of course, made sense in a world prior to the internet when, at least as of 1994, securities filings with the SEC were filed on the Edgar website, this public website, and thus furnished to investors at the same time they were filed with the SEC. So historically there was a distinction, none of this matters, but just since some of you are really into this, there was this historical distinction between furnishing documents to your investors as opposed to filing them with the SEC. That formally originally meant like who you sent it to. Of course, that very quickly took on liability significance. Even in 1952, there was this concern we see in the rule that information you furnish to investors directly would not be subject to the same liability standards as what you would file with the commission. Those distinctions were largely abolished. They were technically formally abolished when furnishing something to investors was accomplished by filing it with the commission. Because that was the case in the early 90s, you then saw the practice that some of you found and emailed me, or that I included a little blog post in my email to the class, where to kind of restore this distinction, right, between furnished and filed, or to say that certain disclosures would not be subject to Section 18 liability, the SEC started embracing this not filed approach, where you can say I'm furnishing but not filed. But that was a much later sort of trying to recreate this reality where you could just give information to investors. It used to be the case that you could do that you could give investors information without filing with the SEC. And that is enough on filed versus furnished. But since we were all in that place. Okay, so now let's return to Texas Gulf. And I asked you yesterday to think about what exactly the dissent was objecting to in the majority's analysis. So who can tell me why, and I want you to focus, we're going to focus now on the materiality debate around the insider trading, whether or not the insiders were trading on material information. More specifically, whether or not the mineral discoveries were material information. It was non-public information, so that part was clear. But whether or not the minerals were material, the mineral findings were material. What does the dissent have to say about that issue? Why does the dissenting judge not find it, judges, two of them, not find it persuasive that the mine discoveries, the mineral content, the zinc, the copper, remember that? Why is that not material in their view? There's a particular reason. Who can tell us? Mariah, you're already getting like triple participation today since you saved me on Westlaw. Go ahead.
Because, so the dissenting opinion doesn't think it's material because the experts think that the holes are only evidence of what was in those holes, and it's not enough evidence to be material.
Yeah. So it's certainly true that we said at the end of class that the experts, the two deans who testified, thought that, I guess this is on page 30, let's see, 31 of the PDF. Some of you asked for PDF pages since I posted those. So page 31 of the PDF or page 872 of the opinion, Dean Forrester and Dr. Park, who was a former dean, thought that you can't really predict much about the entire mine or ore from the hole that you find. Okay, that was a factual point of expert testimony, and that is correct. But there's another point a little bit later in the dissent. Magdalena, yes.
I think it's on page 35 where the dissenting opinion points at the trial court accepting the commission's experts version, which states until which moment in time the discovery was considered as immaterial, and actually all trading happened before that time. So the information that has been furnished to the company, which could be considered as material, happened at 7 p.m. April 9th, 1964, and most of the trading occurred before that time. And this is what has been established by the expert and commissions. I think it's interesting to highlight that these were commissions experts and not defendants experts.
I'm sorry. Yeah, that's exactly right. Magdalena's exactly right. So the trial court believes that April 9th on 9 p.m. is when the information became material. That's exactly right. And that's very interesting because you're right. It's the commission's own experts so we talked about this procedural problem, right? There's a real procedural problem with Texas Gulf, which is that the expert testimony went against the majority's view. And the majority doesn't even remand the case. You notice that? So usually, for those who've taken Civ Pro or federal courts, you know that when the legal standard is changed on appeal, generally you remand the case as an appellate court, right? Because now you're going to have a new factual determination whether or not the facts that were given at the testimony, let's say given at trial, or the facts presented in the factual record, whether or not the facts sustain a particular legal standard is a determination that you would like to give the trial court another chance to conduct, right? And that's simply because there may be evidence that was overlooked or not brought to bear in the first round, in the first decision by the trial court prior to the law changing, that might be important. So if the standard of materiality, now the Second Circuit has articulated this magnitude probability test, I mean, after all, you would think the trial court should have a chance to review it. And that's a point that the dissent makes from the outset, having decided ourselves, speaking of the majority, that we have, why is my thing not working? There we go. Can you hear me now? That's better. Okay. Having decided ourselves that we think that the evidence does not, that this evidence sustains materiality earlier on, we are now going to decide legally that this standard has been met. So it's certainly problematic from the dissent's perspective that it's the commission's own expert whose testimony led the trial court to pin the date on April 9th. But in the preceding paragraph, I want to focus you on the rationale now. So these are the factual bases. Both of you are correct. Mariah and Magdalena correctly pointed out the factual bases. But what's there's a rationale that the dissent is really concerned about in the prior paragraph, right? The one right before this one. Who can articulate what's bothering the dissent about finding that the facts prior to this point in time were material? There's something theoretically, at a general level, that's bothering the dissent. What is it? What is the dissent troubled by? If we were to find that, as the majority did, that the mineral discoveries in November were material. You guys have both chimed in a lot. Let's see. Anyone else? No? No? Andrew? Tell us.
Well, the company was doing a lot of other things besides just that one mineral discovery during that preceding period. So to say that the investors, the insiders who bought stock during that time were relying just on this specific discovery is to ignore all of the other possible things that the company was doing that could have been a basis for their purchase.
That's true. So Andrew says, look, they're doing a lot of other activities, and we might have a problem linking the trading to this particular announcement. I think that's right. But they say something specific in the paragraph preceding the one that Magdalena pointed out. There's a very specific rationale. So that's true. Yes, Magdalena?
I think that the point is that the fact that affecting the price, whatever occurrence affects the price of the stock, there are many, hypothetically, there are many occurrences that could affect the price of the stock. And I think what they're trying to distinguish is that we should focus on facts specific and what is materiality in the facts rather than on looking into what might well affect the price of the stock.
Right.
where the stock could have been affected,
Yes.
whereas the information does not necessarily purport to be material.
Yes, so there exactly. So now we're on the track that I'm trying to get us on, which is that they're concerned about too much speaking. Okay, trying to keep this very simple, right? Where do we see this? Exactly right. It's in the preceding paragraph. I'll just start reading here. Let's see. Materiality must depend on the facts, and the resolution is for the fact finder, court, or jury. This is at the bottom of page 34 of the PDF. The majority state that the K55-1 drilling results were material because they might well have affected the price of TGS stock. Here's Magdalena's point, and Andrew made a similar point, that such a statement could be made of almost any fact related to TGS. But let's draw a little new, I just want to point out the distinction in the two ways you two presented it. So Andrew's pointing to the reliance on the facts as underlying the trading, but here the court isn't actually talking, let's be really precise, about which facts you're relying on when you trade. The concern is what? Well, the next sentence. Well, they give this example that a labor strike could keep the plants idle for months. The strike might be protracted. That might cause them to sell. So that's what Andrew was saying, and that's right. There could be all kinds of bases for trading. But what does the court really hit on? And you see this in the next, 5 sentences. Either announcement. So it's not, the focus here isn't trade or don't trade, or what were you trading on the basis of. The focus is, what do you announce? Let's just be precise. Texas Gulf involves both issues. But the materiality conversation here is really centered on this too much speaking concern. You're talking too much. That's the concern, right? Either announcement might well have affected the market and would to those who bought or sold have seemed misleading and deceptive if the anticipated event did not come to pass. Yet the requirement is going to keep going on about this too much speaking concern, right? The requirement of hourly bulletins to the press from the conference room would not be compatible with common sense. I always fall back on common sense, but okay, there's something wrong with it, right? Scores of day-by-day intra-company situations come to mind, which in the individual opinions of company officers or employees might well affect the price of TGS stock. Each individual reacting according to his own judgment. However, companies listed on a national exchange can scarcely broadcast to the nation on a daily basis their hopes and expectations from the developments in, for example, their research departments. An even more striking illustration, right, would be found within the structure of a large pharmaceutical company, where discoveries of panaceas to cure human disease occupy the workdays of thousands of scientists. Premature announcements of important discoveries would be branded as false and misleading if unfulfilled. In all stock purchases made during the course of their research, pay attention here. This is a key idea. If ultimately successful, would be said to have been made with the advantage of inside information. So let's break down what the dissent is arguing here, because it's a really core set of ideas. Problem number one. Problem number one is that if we construe the materiality standard in the way that the majority seems to want to do it, this is from the dissent standpoint, we're going to be basically putting the company on loudspeaker, forcing the company to just tell the market every little fact. Now, what's wrong with that? What's wrong with that? Well, let's return to our wonderful world of pictures and drawings. Whoa, hang on. And let's try to break down what exactly economically is wrong with hourly bulletins to the press from the conference room, to quote the dissent. So go back to our story. Remember, we said in a lot of these hypotheticals that we're working with, come on, that the firm could be worth, come on, pen. Get the pen to work. Are we back? There we go. All right. So that we said the firm could be worth $9. Can you see it now? There we go. $9, we said, with a 50% probability, or $11 with a 50% probability. Remember this example of the first 2 weeks. We did it over and over and over again. Now, we talked about noise traders, how noise traders can lead to a different bid-ask spread. Remember, we said that if there are 50% noise traders, then we said that the price would be $10.50 and $9.50. If $10.50 if you want to buy, and $9.50 if you want to sell. If you don't remember how we got there, just look at your notes from the first couple weeks. Now, the question that we're trying to understand in the materiality setting, and what's underlying this concern that the dissent articulates, is what happens to this setup when the firm announces a fact. So one of two things can happen, okay? So case one, just break this down very clearly. Disclosure narrows the spread, or you might say reduces uncertainty about what the firm is worth. So the way to think about that is that you have an announcement of some fact that then changes the probabilities. And suppose that in this example that some fact comes out, and now it's no longer the case that there's a 50% chance that the firm is 9 and 50% chance that it's 11. Instead, the fundamental value of the firm is now less uncertain. What do I mean by that? Well, you could imagine now there might be a 50% chance that the firm is worth $9.50 and a 50% chance that the firm is worth $10.50 in terms of fundamental values. These are different from the prices we learned here when we said that noise traders might interject some kind of noise into the market and give us a market price that looks like this. Here we're saying, look, it could actually be that you reach the same numbers because of information, because disclosure reduces your fundamental uncertainty about what the firm is worth. Bless you. Now, in this case, it actually turns out that the market price would not change. Why? Do you remember why? Tell me if you're following. Because you remember that we said that the market, where did the price of $9.50 and $10.50 come from originally? Well, we said it was the average. Remember, we said there was a 50% chance that you were facing an informed trader who's buying because it's worth 11, and a 50% chance that you're facing an uninformed trader who's buying because it's worth 10, and that's how we got 10.50. Did I say it would not change? It does change. Correct myself here. Because now, how does it change? It changes because you have a 50% chance that you're facing, what? An informed trader, but now you know that the firm, if there's an informed buyer, should be worth $10.50. Okay, so see how this works. And a 50% chance that you're facing an uninformed buyer who's, in that case, the firm is trading at its expected value of $10. Let me walk through this one more time. In the original setting, we said that when the information is released, when you observe information, what that does is change your fundamental assessment of what the firm is worth. It could be now, for example, that you think the firm is only a 50% chance of being worth $9.50, or a 50% chance of being worth 1050. Now, the price that you observe in the market, we said, is the average of the possibility that you're facing an informed trader and the possibility that you're facing an uninformed trader. Now, if you're facing an informed trader, you know that the value of the firm, if you're facing an informed buyer, is 1050 now, not 11. Nod your heads if this is making sense. So let me try to correct my confusing delivery of this earlier. While the expected value here is still $10, okay, this is the point I was trying to make earlier. The expected value here is still $10. The expected value of the firm hasn't changed. Actually, the bid-ask spread, or the prices that we observe in the market, do change. They change because now your inference about the good versus bad state of the firm is different. Now you think there's a 50% chance that the firm might not, in fact, be so great, but also a 50% chance that the firm might not be so bad. And this will change the price, right? Now you'll see that the firm trades at 1025 because you have reduced the spread of the underlying value of the firm, even though the information did not change the expected value of the firm. Is this making sense to everyone? Nod your heads if this is clear. Why am I modeling disclosure as not changing the fundamental value of the firm on average, but rather the spread of values? Well, it's because you don't know in any particular case whether the information you observe, the disclosure you observe, is going to yield, on average, a higher or lower valuation. In fact, in an equilibrium sense, in a theoretical sense, it should always be the case that disclosure just reduces, on average, the risk that you face. That it does something like this. It shrinks the spread of possibilities down. And when it shrinks the spread of possibilities down, even though that doesn't change the unconditional expected value of the firm, it will still change the market price of the firm. It will change the market price of the firm because now you infer that if, in fact, the firm is worth, if, in fact, you're facing an informed buyer, the firm must be worth 1050 and not 11. Nod your heads if this is clear. Do you see this? Okay, this is important. So case one that we're studying is when disclosure reduces this uncertainty. What is the net effect? Well, the net effect is that you have less overpayment and underpayment. You can do the exact same math, okay? So this is like before, and this is after, okay? So what happens on the sell side, the exact same thing. Before, there was a 50% chance it's worth $9, and a 50% chance that it's worth $10. And so before we said this is with noise traders. Remember, 50% chance of noise traders. This is noise traders, remember? Making sure we're all on the same page. This is informed seller. And we said, in that case, it's 950. But after disclosure, you just the exact same process, right? 50% chance, now what? That it's worth 950, and a 50% chance that it's worth 10. And so you get a tighter bid-ask spread. Because now, after the firm trades at, you can buy at 1025, and you can sell at 975. Does everyone see this? Nod your heads if this is clear. Give me some feedback here. Okay? Yes, Alistair.
How is that different from like the math before the bid-ask, before the spread narrows? Don't you have the same thing with you can if it's a informed trader, the firm's actually worth 11. And compared to its, like, doesn't this just change the numbers as opposed, like the magnitude, as opposed to the effect?
So Alistair asks, doesn't this change just the numbers and not the magnitude and not the effect? So what are you comparing it to? To when an informed trader bought and the midpoint changed remember we worked through the example where the price kind of, remember that? Is that what you're thinking of? Okay, but there, remember, the midpoint changed. So remember we said that when the informed trader buys, okay, now these percentages change effectively. I'm not going to go through that again, but we broke this down, right? And we said why the percentages change. In other words, we think if we see a sequence of buys, buy, it's probably likely that more than 50% likely that there's an informed trader conditional on having observed the sequence of buys. Meaning, if I observe a sequence of buys, I infer that it's no longer a fair coin flip whether there's an informed buyer, because I would not be likely to observe many buys in a row if there was only a 50% chance of an informed buyer. But that, Alistair, moves the midpoint of the spread. Okay, so that actually shifts the price, not the dispersion of the price between 975 and 1025, right? But actually shifts, which still average to our $10, but actually shifts the average, right? So here, what disclosure is doing in this story, in this case one story, is it's shrinking the spread, the bid-ask spread, but it's shrinking the bid-ask spread not by altering the proportion of noise traders. Notice the proportion of noise traders remains at 50%. Not by altering the proportion of noise traders, and not because we've observed any order flow, which would actually shift the midpoint, but because, and solely because, we have changed our assessment of the fundamental value and shrunk the uncertainty around what the firm is worth. That naturally, of course, shrinks the bid-ask spread. Magdalena. Exactly. Excellent insight. Yeah, she got it. So Magdalena says, well, okay, we'll get there. Yes, you're right. Before we go down that trail, so Magdalena's 3 steps ahead, thinking about the way informed traders behave in a world of disclosure. So we're going to get there. But I want to make sure you understand, that everyone understands. Please nod your heads vigorously if you get this. Yes, Davia. One on this advanced point, yeah. So, right. Yeah, remember we said, great, so remember we said that with zero noise traders, just review this from the second week, the price of the firm, if you want to buy a share, it's going to cost you 11, and if you want to sell, it's going to cost you 9. With zero noise traders, we said prices are perfectly revealing. Remember that conversation? The dealer knows immediately, because you want to buy, that you must have positive private information, right? Because otherwise you wouldn't be buying, because the only people who buy in the world of zero noise traders are informed traders by definition. And therefore, the fact that you want to buy reveals your information, therefore you can never buy at a profit. This is review, just making sure we're all remembering this. Okay? So as we add noise traders, what happens? The bid-ask spread shrinks because there's less information conveyed by a buyer-sell. It shrinks, though, in the following way. Like, look at the B's here before, right? 50% likelihood of a noise trader times what? The value of the firm, if I'm facing a noise trader, is $10 in this hypothetical. Therefore, the noise trader weight, if you will, in the average comes in at 50% in this example, because there's 50% noise traders. And that gets averaged with the possibility that I'm facing an informed trader, and the average yields 1050. That shrunk the bid-ask spread by changing the proportion of noise traders. You see that, Davia? So that's how we got a smaller bid-ask spread, because we added noise traders, which means we made it more likely that if from the standpoint of the dealer on the other side of the deal, if someone wants to buy, they must be buying for some reason that has nothing to do with information. And the best guess in that case I have is the unconditional, meaning just the average value of the firm at $10. So I think if there's a 50% chance that I'm facing a noise trader, then the firm must only be worth $10 in that case. So that's how the weighted average comes together. So one way you can shrink the bid-ask spread is by just increasing the proportion of noise traders. That's easy to see from this example. The higher the weight here, The less the weight here, and the closer you get, it's supposed to say 1050, the closer you get to $10 on either side. Now, the other way, right, you can narrow the bid-ask spread. Let's keep the noise traders in this example at 50%. What you can do is keep the weights as they are at 50%, but you can change the fundamental value of the firm that everyone infers if there's information. What's the fundamental value of the firm? Well, it's what I think the firm is worth if I observe a buy, if I'm the dealer. And one way to think of disclosure, the good way to think of disclosure, is as reducing that uncertainty. It reduces the possibilities. So think about Texas Gulf. How does this work? Well, imagine that when the mineral disclosures are made in this world where they would have been made in November, what's the question that the dissent is posing to the majority, the challenge, is whether this is going to happen, right? Because what the dissent is saying is, look, is it really the case that by putting the firm on loudspeaker that you're going to be shrinking the possible spread of fundamental values that the firm has? If so, then disclosure reduces the bid-ask spread. Is this clear? Yes. Tell me. Sungha, yes. Right. That's our assumption. Yeah. Sure. So we can move two things at once. Okay. Great. So you might get a problem like this where two things change, right? And the intent of a possibly multiple choice question like that is just to see if you can do that calculation, right? Which is just, if I were to say, now some information is released, and the possible values are as follows, and it turns out that there are now 25% noise traders instead of 75% noise traders instead of 50, because there are fewer informed traders, you would just plug those numbers into this calculation to get the new bid-ask spread. Absolutely. On your first point, though, Sunga, it's very good. I want to make sure you see why this actually economically almost always pretty much has to be the case. It has to be the case. Well, what has to be the case? It has to be the case that disclosure has some symmetric value effect on the inferences about the firm. In other words, it's very unlikely that disclosure per se changes your fundamental inferences in one direction or another. The reason, on average, I'm going to keep going back to this on average point. In some cases it will, in some cases it won't. But on average, you should start to have this intuition now. Disclosure reduces overpayment and underpayment risk from the standpoint of the investor. It doesn't turn $10 companies into $11 companies. That's the intuition you should start to develop. It means that think of these numbers like repeated bets at a casino, right? Sometimes you'll bet and you'll actually pay $10.50 for the firm that's worth 10. Sometimes you'll bet and you'll pay $9.50 for the firm that's worth 10. And you might be on the other side selling. And so these numbers reflect your on average overpayment and underpayment if you were to just be who? A noise trader. If you were to be a noise trader and just buy or sell randomly. The way to think about these numbers is that they reflect the losses you would make as a casino gambler, right? They reflect the losses you would make on average, because sometimes you would buy the firm, the $10 firm, at $9.50 and you'd make 50 cents. Sometimes you would buy the $10 firm at $10.50. In other words, these are the numbers that constrain, that define the gamble. And so disclosure in any particular instance may actually give you an opportunity, what we call an arbitrage opportunity, to make money on a trade. But it may also mislead you. And that's the point the dissent is making. That it's not that if we give the mineral disclosures, somehow that is going to make the firm always more valuable to investors. See, that's the dissent's point, right? You see that? Right? The dissent is saying, look, sometimes those mineral disclosures are going to mislead you. You're going to think the firm is worth more than it actually is. And so you're going to lose. So it's just a gamble. Maybe a gamble that is less risky than the one you would have played if you didn't have the information about their minerals. But that's the question. It's just a gamble. It's just a bet. Does everyone see this? Developing kind of this intuition in different ways. Yes, Abir.
I'm a little confused about the narrowing of the bid-ask spread.
Yes.
So intuitively, I understand that if you have more information about what the expected return is going to be, there'll be less uncertainty around the expected value. But why do we, in terms of, so I understand that the variance would
Yes.
become narrower. I don't understand why we change in the math, why the first expression goes down from 11 to $10.50.
Because I've now observed some information like mineral content of their mine. So imagine, this is a great question. So Abir says, why is it that, I think I'm going to rephrase your question, but tell me if this is right. Abir's asking, why is it that disclosure actually narrows the spread or the variance of inferences that I can make about the value of the firm? Well, let's just walk through Texas Gulf and see how this works. Prior to the mineral disclosure, which didn't happen, but say we're in October of the year 62 or whatever it was, 63, you know, you're looking at Texas Gulf and you're thinking, okay, there's a chance that they're going to strike it big. There's a chance that they're really going to have not just one mine. They might have 100 mines. Who knows? They might be the next, most valuable company in the country in 5 years. I don't know. They might be a complete disaster. Those are equally, when I know nothing, I think anything's possible. I just don't know. Now, I learn that there was a discovery. Now, what does that tell me about the firm? Well, it could lead me to conclude that the firm is worth more than it is. But on average, announcements about discoveries like those are going to have the effect of pinning down with greater certainty what the firm is actually worth. And in this example I'm using, you should think about the $10 here as being different for every firm. In other words, think about the $10 as this is the expected value of investing in companies in the stock market. This is my expected, on average, gain, if you will, in making investments in the stock market. We saw in the IPO case that's something like 22% a year, on average. That's what I will make on average for any firm. But because I know something more, I know now that there's a mineral discovery, I kind of have a much better sense what the firm is actually worth. I've shrunk that uncertainty. Go ahead, yeah.
I understand that the uncertainty has shrunk, but why does it move towards 10? Why doesn't it move toward 11?
So it could move, okay, great question. So think about this like the $10 is your average portfolio return from doing this over and over and over and over again. The $10 in all of these examples isn't like the actual price of a particular stock. It's your hypothetical portfolio gains, portfolio return that you would have by investing over and over and over and over. That's a number. That's fixed. It's something like 22% in the case of IPOs. We saw that in the IPO table. when people say stocks are worth 6% on that, increase 6% on average, the $10 is like the 6%.
So,
Do you see that?
so we're saying that the information received is neutral. So we're getting more neutral information, not more good information.
You're getting more information.
Okay.
Sometimes, the difference between ex ante and ex post. Ex ante, you do not know whether the information is good or bad for the value of the firm. Because this is the point that Dissent is making. Put the firm on loudspeaker. Announcement, 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 announcement. Could it be that on average, all of those announcements for every firm increase 11, 12, 13, 14, 15, 16, 20, infinity? No. It can't go to infinity, right? It can't be that every announcement that a firm makes across all those announcements, across all firms, is going to be positively increasing the value of the portfolio, because as you have more announcements, that means on average the value of the portfolio goes to infinity, because there's another one coming and another firm and another announcement. And do you see this? This is how averages work, right? Like on average, it could be in some cases it's positive, but on average it's got to converge to an average, meaning some of the time those announcements have to be negative. You see this? Otherwise, all announcements would just forever drive up prices, right? Or forever drive down. So in other words, it's sort of, again, I said this to you early on in the class, a lot of finance is almost like tautological. There's like a certain tautology feeling. Like, of course, the average return is a number less than infinity. It's 22%. By definition, some must be above and some must be below the average. And so the $10 hypothetical here isn't like the price of the single bet, the single firm, the single gamble. It's the average return to many gambles, ex ante. And that you as an investor think, okay, this is what I'm likely to make. I'm likely to make on average a certain amount, which I'm using $10 for, and some of the time I'm going to beat it, and some of the time I'm going to lose. But with information, I'll beat it by less and lose less by definition. It has to be by definition. It cannot be the case that disclosure only reduces my losses. Cannot be the case. This intuition takes some time to develop. Yes, sir. Let me make sure I got you. Reginald. Yes.
So I'm just a little unclear if, like, disclosure can be misleading and, like, it can be idiosyncratic, right? Does disclosure have any purpose, right? So if I don't know what disclosure is going to do for the value of the firm, then, like, does it matter if things are disclosed or not?
Say that one more time. So I think this is a good point. I think you're onto something here really, really good. So I don't know what disclosure is going to do, so does it matter? So you're saying if it doesn't change average outcomes, does it matter that we've shrunk it from 911 to 950, 1050 in this? Great, exactly. No, it doesn't from the standpoint of average returns. One of the classical objections to disclosure rules by economists in the 1960s and 70s is that investors only care about averages. You don't care if you lose a lot at any point in time. Now this is like drilling this intuition into your heads, right? It's a coin flip. Why do you care if you lost $2 or gained $2? Why do you care if your portfolio went down by, let's use some real numbers, by 20%, went up by 20%? Do you care that some IPOs are 70% too expensive and others are 70% cheap? Do you care? Can someone tell me why you might care? This should be, yes, Ophir.
Well, so besides the cyclical kind of consumption
Right.
pairing,
Cyclical consumption's good, yep.
but there's also kind of just like people are loss averse, and so if there's, the chance that their losses are greater, even though on average it's the same, you might just not participate in the stock market at all. And
Yeah. That may not be a bad thing, by the way, for loss averse people not to participate in the stock market. Ophir makes the answer I was looking for was the cyclical consumption point, which now should be starting to think about this every time we talk about risk. Like the formal rational reason that you care about losing possibly all your wealth and gaining, doubling your wealth, like the reason why you care, why those are not the same to you, is because if you lose 70%, you don't get it back when you gain 70%. So let me try to be more precise. The reason why you don't care about bets like these, if they cancel out all the time, let's just put it that way, is that you, if it's uncorrelated with your consumption, you don't mind the fact that you lost. So we've given this now cyclicality story in office hours. We talked about this. You care about losing. You care about overpaying if you need to eat with that money. We've hit that. We beat that horse, right? We got that. So the way to think about what disclosure is doing is reducing the chance that you'll overpay or underpay. It cannot be changing the average return to investing in the stock market. It cannot. Why? What drives the average return to investing in the stock market? The profitability of the firm. Do you see this? The $10 here is like the wealth created by companies in this country, annualized and in percentage terms. It doesn't change because you get more information about what the firm is worth. Simplifying, there can be some stories where it might, but let's just keep this. Fundamentally, the growth of the U.S. economy does not hinge on whether you've overpaid or underpaid and by how much for a particular investment. The growth of the U.S. economy, or how much companies are making in sales, has very little to do with whether investors overpay or underpay for their shares. The average return to investing in the stock market has very little to do with disclosure. Does everyone understand this? Is this, nod your heads if this is clear, raise your hand if it's not, because this is important. Davia? No? Michael? Yes. Okay. Let's just make sure this is, what is it, $10, right? It's just the average value of companies in the economy. Think about this not in terms of like my investment decision in firm X, but across all my investment decisions. Some are going to be worth 9, some are going to be worth 11. That's just like saying across all the companies in the country, some are really valuable, some are not so valuable, but they have an average value. And we're just using $10 as a tool, as a fill in the blank, as a placeholder for what that average value is. Is this, I think maybe now it's starting to click for some of you. It's just a tool. It's just a way to think about the average. The average is fixed. It doesn't change. Remember the IPO table? It's 22%. Some years it's plus 70. Some years it's minus 50. It's 22% on average. Any further questions on this? I want to make sure we have the time. This is important. Okay. Abir, yes.
So I understand that story if we think about portfolios. But for any individual firm, I thought when we started off, there were only 2 possible outcomes in the world, a $9 outcome or an $11 outcome. So you either have a good outcome or a bad outcome. And the 10 is just the average because we don't know what the outcome is going to be.
Yes.
But if we do have more disclosure about a certain firm, the firm can't be an average. It'll either be 9 or 11. So wouldn't any one particular firm, so it wouldn't be like 1075 with a spread of like 0.25?
I somewhat misled you when I said that you can think of the 9 or 11 as like fixed properties of the weather, which is, I think, where confusion is coming from. That was to start us off. And then I said, look, I think this was in the 2nd or 3rd class. I said, remember, we can just shift our thinking seamlessly from thinking about 9 and 11 as kind of fixed numbers that God has ordained, right? Like we can flip that and just think about those as the best guess I can make of what the company's worth if I know nothing about it. And then as I learn something more about it, I can make those guesses a little bit better. So it's not that companies can only be worth 9 and 11. And as we've revised and extended this story, we've said the way to think about 9 and 11 is just my best guess of what the firm is worth if I know nothing. Of what all firms are worth if I know nothing. That out of 1,000 firms, 500 of them will be worth 9 and 500 will be worth 11. I don't know in this particular case. I don't care. I'm just playing the lottery. Sometimes it's going to work out great. Sometimes it's not. That's my average.
But as I get more information, I realize, oh, wait a minute. Companies, I can pin down that average a lot better. I now can say it's 950 or 1050. It's the same logic, just changing the numbers here. But what disclosure is doing is reducing my uncertainty about what the firm is worth. Michael? Right, exactly. So Michael says, look, if I'm an index fund, well, I might in a macro sense, right? I might because it might be that I'm in the S&P, and if I could. So Michael asked, what if I have an index fund? Because the index funds, what do? They just hold an index. That means half the time they overpay, half the time they underpay, and they just always get the average return on the market, or the average return on their index. They might care about disclosure for the entire market, though, because it smooths the volatility in bad times, right? So if all firms on the company, all firms in the market think about like fraud risk, okay? So if all firms in the market are disclosing according to good accounting principles, auditing principles, what that does is lower the likelihood of an Enron-style explosion, where I have even index funds putting their money into some firms that are worth zero, right? And so if you reduce that, while it's true that you're unlikely to change, it's not that the securities laws turn the stock market from a 6% per year on average gains to a 30% on your average return. But what the goal of disclosure legislation is to just kill some of those Enron-type cases, just prevent them from happening, right? Because why? Because even index investors don't want to see their portfolios crash. Notice what's interesting about Enron is that it happened right around September 11th, right? So you don't want, if you're an index fund, the entire market to have fraud in it, not because you're worried about losing in any particular case, but because it could be that you get a few fraud losses that hit at a weak economic time, and that has a bad effect on consumption, right? That's something that risk-averse investors do not like. But that has to be your story. Otherwise, you're exactly right. And a lot of literature in this space was basically making that point. Why should we invest in all this costly disclosure? If investors are fully diversified, meaning they're just as likely to gain as they are to lose, why do we care about narrowing the spread of outcomes? The average return on the market is the average return on the market, period. It doesn't matter. That was a big objection in the literature. More in the back. No? Yes. Lauren? No. Lauren?
Hui Zhen.
Hui Zhen.
Yeah.
Hui Zhen, there you are. Yes.
So when we spoke about the informed trading hypotheticals, we talked about how informed trading leads prices to converge to fundamental values.
Yes.
But in this situation, it moves further away from fundamental value because, like, the prices.
Well, we've now changed. The whole market has more information and has changed its views as to what the firm is worth, right? So now the entire firm, the entire market with disclosure is more informed. So informed traders have less of an advantage than they would have had otherwise, which is what we were saying, what Magdalena said earlier, right? So just to not be confused, in the informed trading story, we kept the fundamentals at 9 and 11. That's why I think some of you are, remember when we said they trade up to 9 and 11, we just said, like, this is 11, this is 10, and they just, that doesn't change. All we do is observe informed trading, and we get to $11. Now we're saying, look, disclosure can actually change what everyone thinks that the firm is worth.
But it goes, do the same number of people think that it, like, interpreted the information as bad, and the same number of people interpret it as good?
Good question. Do the same number of people interpret it as bad? In the baseline story we're telling, in this simple story of disclosure, the answer is yes. Now that's bothering some of you, like it's bothering a beard. It's like, it can't be. In every case, that disclosure just makes like half the people a little bit less optimistic and half the people no. In any particular case, you could move one direction or the other. But the claim here is that on average, disclosure should no more benefit the optimists than the pessimists. That's the on average claim. Okay? Now, it does, just because there is disclosure doesn't mean that you've lost your potential benefit or gains to informed trading. And I think this is where maybe it'll make a little bit more sense. Suppose that the disclosure does two things at once. It not only, and this is one more step here, but we'll follow this, it not only changes the probabilities, but it actually, because you put information out there, not everyone understands that information, and so it actually turns more people into noise traders than there were before. Right? So think about how that would work. So suppose, and this is kind of what's bothering the Texas Gulf Dissent, right? So what they're saying is, look, of course you can put your mineral content out there. You could broadcast everything about the firm. But how can we be sure that it's going to narrow the uncertainty around the value of the firm? And how can we be sure that there's actually going to be information conveyed? So you could actually imagine disclosure, and this is sort of goes back to Sungha's point. We can work through we can push a few different levers here, okay? So you can imagine that it actually changes these percentages. So let's just look here at the A row, okay? So you could say, look, you know, when the mineral content gets out there, there's now a 25% probability that I'm facing an informed trader. Even though now I know I have a better sense for what the firm is worth, there's a 75% chance that I'm facing a noise trader. Well, what is that going to do? It's going to shrink the bid-ask spread even more, because there's even less information now out in the market. Now, what does that do? I'm moving a little bit faster here, but for those of you who see this, what does that do? That actually reduces the profits to informed trading, right? Right? Because the firm trades closer to its expected value. So one of the problems is how, as an informed trader, as a listener, you can exploit your informational advantage. We'll come back to that point, but I just want to make sure this is clear. If you shrink the proportion of informed traders down, because you put information out there that people can't understand, what do? You turn more people into noise traders. You take the price, don't worry about the math, you take the price closer to $10. What happens as a result? As a result, you can make what? More money as a noise trader. You see that, right? You can make more money as a noise trader because you can buy at 10 and you know that it's 10.50 and there's less competition. Why? Because the price starts out closer to 10. Does everyone see that? Yes.
This sort of point is where I get a little confused by the rationale of the dissent, because I would think, understanding this, you have to kind of discount noise trading because it will happen. And so the dissent says on this point, I think, if I'm understanding this correctly, in so holding, they, the majority, confuse the inducing motive of the individual purchaser with knowledge of material facts which ought to be revealed to the public at large. There are people in the public at large that I suppose we could call potential informed traders who would react to that information. Not everyone in the public at large is a noise trader. And considering that this information that the insiders had didn't seem neutral, they all chose to buy stock and options on it.
You got it.
That's where I'm finding a problem with this, with the dissent.
Exactly. You're exactly right. So, Ben? Yes. So Ben nails it. Ben says, look, the challenge is to reconcile with the fact that informed traders, we observe in the data that these insiders were buying. How do we reconcile that with the concern of the investing public being misled? Notice, the investing public, as a noise trader, is always going to lose if they don't have either private information, some kind of secret knowledge, or they don't have the specialized skills to figure out what's being said. So in addition to narrowing risk, this is Ben's point, we actually see that the disclosure can change the proportions, can change the weights here, because some information is very hard for the average investor to figure out. But the average investor who can't figure out information is going to always lose on average. Does everyone see that? You're going to be like a noise trader. So the challenge in Texas Gulf is reconciling, goes back to our broader theme around disclosure versus informed trading, whether or not, there's two questions. A, is disclosure actually narrowing the spread, reducing uncertainty? And B, what is happening to the distribution, to the weights of noise traders and informed traders in the market? If you give out the mineral facts, are you actually telling the entire market this is a better estimate of what the firm is worth? The dissent is not convinced on that point. But then there's a problem with saying, yeah, look, I mean, if you were to put this out there, you would reduce the spread, and that would benefit the investing public, because it may be that members of the investing public don't understand what is being disclosed. They don't understand what the mineral content means, and as a result, they become more like a noise trader. Now, that moves prices closer to the expected value, but it benefits who? Benefits informed traders. It benefits informed traders. Why? Because they can buy at 10, just look at this again, the lower the starting point, the more room there is to profit. So there's really two questions in Texas Gulf. A, does disclosure of a particular fact increase the certainty we have about what the firm is worth? Reduce variance. Make it clearer what the firm is worth. And B, does disclosure change the proportion of noise traders and informed traders? So Suma pointed out earlier, it could actually shrink the proportion of noise traders. It could make more people informed. Or, if folks don't understand what they're reading, it could make them less informed relative to those who do understand. The effect on the price is driven by those two questions. The consequence of disclosure is driven by those two questions. So let's just review an application so you would think about how you would answer a question like this, okay? So just trivially, we're back to our 9 and 11. I'm just going to walk through quickly. 50% to start with of each. 50% noise traders. Fact X is disclosed. This is how a problem like this might look. Fact X is disclosed. Now, there's a 50% chance firm is worth 1025, and a 50% chance firm is worth 975, and only 10% of traders have information. Now, there's another way to say this is like only 10% of traders understand. Just walking you through how a problem like this might look. Understand the implication of fact X for the value of the firm. These are different ways of saying the same thing. Okay? And then the question might be something like, what is the new bid ask spread? Okay, who can calculate it? 50% chance the firm is worth 1025, 50% chance it's worth 975 after the disclosure. 10% of the traders have information, or only 10% of the traders understand what fact X means. Yes, Sam?
Yeah, I just have a question. Is this, you say 10% of traders, is that 10% of the volume?
Just 10% probability that you're facing an informed trade, right? So what's the bid-ask spread? So cost to buy, you can just always write cost to buy. You don't need to worry which one is bid, which one is ask. What's the cost to buy? Has someone done it already? Just a weighted average. 10% chance that I'm facing a firm that's worth 1025. Why? Because I have an informed trader, and there's a 10% chance that I have informed traders, plus 90% chance that it's worth 10. Someone did the math. Okay. Cost to sell, 10% chance, 975, plus 90% chance it's worth 10. Okay. Everyone understand this? That's the answer. You would just plug it in a calculator. Or you don't even have to calculate it. Just write that, okay? Okay, this is clear? Now, here's the claim. Question, did you have, Davey, did I see him? Sorry. No? Later? Alistair?
Just because this is in the context of how we would approach a question.
Yes.
You were, in the past, you've been talking about how this is the average effect. Are we, like, if we're talking about a specific disclosure in a specific question, does the fact that we're talking about the specific impact instead of an average effect impact how we approach the problem?
Well, you might imagine a variant on the question, which I probably would not do because it would just confuse you. But I like to say, you know, now that I could look, we could, when I say now that there's a 50% chance it's worth 1025, 50% chance it's worth 975, I mean, I could change the expected value there, right? But I won't do that to you because this is complicated enough. Okay? I want to make sure you understand how this calculation works because I want you to understand the way that informed trading gets into prices. But that's it, okay? It's not like going to be a difficult math exercise. I want you to just be able to do that calculation. You're right, you could certainly say in any particular case, okay, but I want you to just focus on market averages. Now, for that reason, it won't be like that. It'll just be like this. And this is just an exercise, okay? Now, I want you to see that the materiality standard, this is the takeaway, and we'll talk a little bit about this at the beginning of next class. The materiality standard is designed, at least should be designed, theoretically, to give us the tools to achieve the outcome we want here, from a policy standpoint. So the answer to the question, what is materiality? How do we actually apply this incredibly meaningless, like, you know, magnitude and probability test that basically can mean anything in any setting depending on who you talk to? Well, there's a theoretical answer. Theoretically, the materiality standard should compel disclosure that does what? That A, reduces risk, particularly risk that's macro-cyclical. Reduces risk, by that I mean it shrinks from 9 and 11 to 10 to 950 and 1050. And B, materiality should be a threshold that compels disclosure so as to change the distribution of informed and uninformed traders in a way that's normatively desirable, that's socially welfare enhancing. Now, we're going to spend some time over the next few weeks thinking about how much informed trading do we want in the market. But as a starting point, it should be clear to you that any particular fact, once disclosed, changes two things. It changes the risk of investing on average, the average ex-ante risk that you face as an investor, and it changes the chance that you actually know what the firm is worth. And this, Abir, is where I want you to think about knowing what the firm is worth. It's not, remember, the expected value of this 9 and 11 or 15 and 17, wherever, that's what everyone knows. The only people in all these stories who actually know what the firm is really worth are the informed traders. So by changing who is an informed trader, by giving some people an advantage and figuring out, oh, mineral content means TGS is actually going to be worth $56, by bestowing that knowledge on some people, what materiality does is change who gets that profit. That profit, on average, is not zero. The profit to informed trading is not zero. In fact, it depends entirely on how many informed traders there are. The more informed traders in a market, the less of a profit there is to informed trading. Remember our example of 100%. These ideas will start to click. We're going to keep hitting them. But I want you to be thinking, the party who wins on information is the party who knows what the information means. It's not the general public. All of these general stories about how much the firm is worth, 50% chance, 50%, they always mean zero because the average of zero, because the average investor is stupid. They just don't know. And so they're betting, on average, in either direction. The informed trader knows. The disclosure, to say again, can do two things. Change the risk that everyone faces of investing the public information about a stock, and two, how many individuals out there are actually equipped with the tools to understand what that disclosure means. And so this is why there's really three categories of traders, right? There's uninformed traders, truly uninformed, noise traders in our story. There are informed traders who actually have secret information. That's like your friend the weatherman from the first week. And then, but now we kind of moved away from that group in this conversation, and we're focusing more on those who are endowed with some kind of information processing capability, who when they hear 5% zinc, 10% copper, whatever the figures were in TJS, they know what TGS is worth. Disclosure of the mineral content would benefit that group and also possibly reduce the general risk that the public faces in investing in TGS and companies like TGS. Because disclosure of the mineral content for TGS is not just about TGS. That's the point. It's about other firms who are faced with similar disclosure burdens. That's what materiality does. So the question we're going to be asking, and I'll post the readings for next week, how much should the law require companies say? And the answer is going to be tied to these 2 points. How much risk does it reduce? Does the information reduce? We like risk. Remember, that's linked to the macroeconomy in some way. We like risk reduction. That's linked to the macroeconomy. And who does the disclosure benefit? These 2 questions are really the questions for the entire class. Like the entire course is about these 2 questions. Think about the roadshow. The roadshow reduces risk but benefits a certain set of investors back in the IPO setting. It's just the same problem translated to a different setting. You'll start to see these connections as we keep hitting it over and over again. All right? We're out of time. Have a wonderful weekend. I'll post. There will not be office hours on Wednesday next week, but probably on Monday I'll have time to meet with those of you who would like to meet. So be in touch with me if you want to meet to talk about this. Monday might be a good day. I can also schedule possibly on Tuesday or Thursday or even Friday with some of you if that works also. Okay, have a nice weekend. Hi. Yes. Oh, I'm so sorry. Yes. Oh, that's fine. I don't even. Do you want the recording? Yeah. Just you email me. Did you email me? Oh, just email me. I'll send it to you. Yeah. No problem. Absolutely. Yes. Hey, David.
See the last example that you wrote out? Because
Yeah.
I wasn't able to record it.
Absolutely. Absolutely.
So I just wanted to
This one here.
picture, like the thing, sorry.
No problem.
And wasn't there a list of
No, well, so I was just writing kind of sloppily, but so imagine we start with 9 at 50, 10, 50% chance of 9, 50% chance of 11. We disclose some fact. It changes 50% chance of 1025, 50% chance of 975, right? And then I said now only 10% of traders understand what this means, right? What is the new bid-ask spread? And it's just the same calculation that we've been doing before, but I'm just giving you a different way. Is there any part of that that's confusing for you? Tell me.
Okay, so I'll have her ask you her question first, and then I can best
Okay, I'm flexible.
articulate
Okay, yeah, sure.
what my concern
Sure,
is.
absolutely. Go ahead, yeah. Yes, please.
I guess while she's
Yes. Oh, either way.
yeah.
No, I don't think there's an event here, so I think we're okay. Yeah, go ahead. Yes. Well, the dealer would set a price of 11, 50, like 50% of the time I'm facing an informed trader. In that case, I know the firm is worth 11 in the original hypo, so I'll charge 11.
Okay, but after disclosure, this changes into 1050.
Yep.
But I don't understand why it goes down, because if you have more information, wouldn't you know that the firm is worth $11?
In any particular, I didn't say you had this is on average. I didn't say on average you get positive information, rather you get more information. Some of the time the information is going to be positive, but some of the time it's going to be negative. So some of the time it's going to tell you that the firm is worth more, and so it's in this story, on average, disclosure just makes you more certain what the firm is worth.
And
Some of the time you're going to get bad news.
oh, okay.
Right?
So it's not always good news.
Right.
That's why it goes down.
I mean, that was the dissent's point, right?
Right.
The dissent says, look, maybe the mineral content is really bad news for the firm because it means it's going to crash and burn. Like you're going to make this big investment, then you're going to find out, in fact, this was not worth nothing, right? So the information could go either way. You don't know because you require disclosure that's going to sort of forever increase stock prices, right? Like it could be bad news. Like it could have a bad value implication for the firm is another way to say it. Does that make sense?
That sort of makes sense.
Yeah. See, our intuition is to think, more information is better, meaning the firm it's got to be worth more because I know something now. But it could be worth less, right? Now you just know better what it's worth. You don't really know which way, and on average. Like on average, those are just going to cancel out.
Okay.
Does that help? Yeah. We'll keep working through it.
Okay.
Yeah.
And also, like on Wednesdays when you have office hours, I
Yeah.
have classes, so I wasn't able to go.
We can find a time. Yeah, no worries. Yeah. Can you send me an email? I think Monday might be a good day. Tuesday, Thursday, or even Friday, we can set something up. Perfect. Looking forward. Tell me your name one more time.
Yedin?
Yedin.
Yeah.
Great. Okay, nice to meet you. Of course.
Thank you.
Where are you sitting?
This is me.
Okay, great.
Thank you so
No problem.
much.
Yeah.
Okay.
Yes, Davia. No worries. Thank you. Yes, we need to find a time. Maybe I think Monday afternoon should work. I just have to confirm.
Okay, I just didn't
Yeah.
want to impose like.
No. I think I should be here. I have to double check, but I think that should work fine.
Okay, so
Yeah.
trying to understand this.
Yeah.
Yeah.
You're doing great. I think you're doing pretty good. Like I think you got most of it. Yeah. Tell me.
Okay, so all right. See, like as I'm reading, my intuition is not the explanation that you give the board in that, like to think of like using numbers. That's not where I go with it.
Yeah.
Me, I was able to kind of understand what the problem might be. It's like we keep asking if we like require more disclosure because like if it keeps like the hour by hour type of scenario, then like that confuses people because you're not giving them because you just learn let's say you learn this deposit is really good or whatever. You drill the hole, it seems like there's nothing there, right? And so on this hour they receive that, so people think
Right.
the firm